Fed fears, European contagion, once again driving global markets this morning. Joining us now, Jim Rickard, Senior Managing Director at Tangent Capital Partners at the CME. Bob Iacchino, tradersoutlook.com. I'll just start with you quick, Bob. Friday, I thought that maybe we had done enough work on the downside, but we're going to do more today, based really on no new info, right? It's still the guy leaving from one Jurgen being replaced by another Jurgen. They got those little things over their U's.
What is that? The little things over the U, you mean?
I learned about
the two
that.
dots.
That's an umlaut?
What do you call that?
And it would have been an E over the U, but the E, it used to be written with like
what is it when a U with a line over it? What's
it's
that?
a U E with a line over it. I don't know what it is. Anyway, Iacchino, why didn't we do enough on Friday? We got to go down again?
You guys have completely lost me. Jorgen, I don't know what you're talking about,
He's a
but no.
German guy who left that caused the market to go down, unless you think the market went down on the jobs plan Friday.
Well, I think it's a little bit of both. I think it's a lot of everything. You know, unfortunately, we do have more work to go to the downside, and this is one of those situations you hear these just repeated stupid market cliches, and that one about catching a falling knife is actually happening now, as opposed to every other time it's said, every time there's a 1% down day. It's happening now over the medium term in the markets. This is a falling knife, and unfortunately, this is one of those times where you sort of have to look at the market as a hot air balloon. If you want to grab something going up, you want it to turn and go up and then grab on and climb in as it's going up. I don't think buying a dip, I don't think dollar cost averaging is the plan here. I think you need to wait for the markets to base. The dollar index had a big spike last week. The last time we saw a spike of that nature, if it were to continue, is 2008, as the brunt of the crisis was really taking hold. So the dollar index is starting to tell us that this needs to get a lot worse.
Jim, you know, I look at 137, 136 on the euro, I start feeling good about myself. But then I realize that, and this is after all the horrific economic news in this country and that zero jobs number.
Mm-hmm.
So we're looking better, but I mean, this is really beggar thy neighbor. We all are awful, right?
It is beggar thy neighbor. It's really beggar the world at this point. I mean, we see Brazil and Switzerland. You know, Brazil lowered interest rates. They have an inflation problem. They decided to lower rates. Switzerland is kind of intervening in the capital markets. They're both trying to cheapen their currencies, or put a lid on it, or cheapen their currencies one way or the other. This is the outbreak of the currency wars. We've seen it coming for a few years. Now,
what is the end result of that?
Well, the end result is a trade war, because it's the kind of thing where, well, two end results. One is a trade war. Not everybody can devalue against everybody else. We know that. So it's just mathematically impossible. So when you take it to the next level, you start putting on excise taxes, import controls, capital controls, et cetera. The other end game, which I don't expect for a few years, of course, we talked about before, is gold, where you just sort of reconfigure the whole system. So, okay, we're going to cut this out. We're going to peg to gold on a worldwide basis, and then have some
back to gold?
Some kind of new modified gold standard. Right?
Really, when would that happen?
Well, it's a couple years away, Andrew. These things don't happen overnight. Well, because yeah, there'll be a new international monetary conference. It's not sort of a wild prediction. It's just the way the system has to play out. You can't devalue your way to prosperity. Joe said before, you can't deficit spend your way to prosperity. We don't have any growth. The consumer is flat on its back. Investment is flat, because if the consumer is not there to pick up the goods, who's going to invest? Government spending has hit the wall, so there's nothing left but net exports. To do that, you cheapen your currency, but everyone can't do it at once. I mean, the numbers don't add up.
So we won't do these trade deals then either.
The trade deals would be a good idea, but there's going to be a lot of resistance to that. I thought it was interesting that you know, Governor Romney came out the other day and talked about import taxes on China. The other voice saying that is Chuck Schumer. So when you have a Republican and Democrat sort of agreeing on that, this will be a big campaign issue in 2012.
How much exposure do you think the U.S. banks have to Europe, to France, the U.K., and whatever else you think comes out of the Greek problem?
The exposures are really kind of bogus, Andrew. The reason I say that is because people say, well, we don't have much net exposure. The European banks are saying this, the U.S. banks are saying that. But what they mean is they own the bonds, but they bought some CDS, they bought some insurance. So they're sitting there saying, on net, we don't have much exposure. But it begs the question, who sold the insurance?
Right.
Let's just say I'm a hedge fund, right? So I sell you some insurance, you pay me a premium. I get to the end of the year, my phony baloney model says that that's all profit. I take a 20% bonus for myself. In year two, you know, Greece defaults, you claim the insurance. I'm not there to pay it. I close down my hedge fund, right? So I fail, you fail, but I still got my bonus in the bank. And that's how kind of rotten our system is now. So until we ban naked credit default swaps and get rid of these, you know, VAR, called voodoo at risk.
Do you think that all of the banks in the U.S. that say that they have no net exposure, or very little net exposure, it's a function of buying? They've bought CDS, and they bought it from who?
Well, that's the question. See, we know who the Lehman is, right? The Lehman is Greece. We don't know who the AIG is. I mean, who is it? That's a very good question. They bought it from somebody. I'd like to know, when they say I have no net exposure, I'd like to know what's your long, what's your short, and what's the credit exposure on the short.
And you don't think they've dumped the bonds?
Some have, but they've sort of trickled them out. But there's no market for these bonds.
They'd be so stupid if they hadn't, right? I mean, the European community has set up a system where you could dump all of that stuff. I don't understand why the European banks still,
back to the
ECB.
Well, they're buying some of it, that's true. They bought 100 billion euros of it, but there's a lot more than that outstanding. Certainly when you look at Spain and Italy, it's in the trillions. So they can't possibly have sold it all.
All right. Very good. Thank you. Thanks, Jim.
Thank you, Jim.
Bob, thanks. We're going to combine you guys and